Topic 13, Option Contracts, Hedging, Monte Carlo Valuation, and Black-Scholes. Copyright Lou Gaddis. In this topic, we're going to calculate the payoffs and profits of plain vanilla option contracts, value options using Monte Carlo and Black-Scholes models, compute hedged and unhedged cash flows using options and forwards, value arithmetic Asian options, and use at-risk the value options and compute position risk. So let's start off with the definition of an option. Last topic we talked about a forward contract, and a forward contract is a contract in which two parties get together and exchange an asset for cash. And we said that the buyer of the forward, we call one of the parties of a forward contract the buyer, that's the person that buys the asset, and the other will be the seller. Well, a call option is like a long forward contract. It's a contract to buy an asset, but you can walk away from it. In other words, you have the right but not obligation to buy an asset in the future. So in this case, the owner of the option has a choice. The seller of the option, on the other chance, waits for the call option holder to exercise, and therefore is contractually obligated to deliver if the call owner decides to exercise. A put option is kind of like a short forward contract, except the party can walk away. So a put option is the right to sell an asset in the future, but they have a choice to walk away. In other words, it's a right but not obligation to sell an asset at a particular price. Now, with forward contracts, we talked about the forward price, the futures price. That's the price at which you get to buy or sell the asset in the future. With an option, we just call the price a little bit differently. We call it either the strike price or the exercise price. Also, with a forward contract, there is no exchange of cash up front. Two parties just agree to buy an asset or to exchange an asset for cash in the future. However, with an option, one party has the right to walk away. That's the owner or the buyer of the option, say the call to put, and that person must pay the seller of the option a premium, or sometimes called the cost or price of the option. So when looking at options, you need to know the underlying asset. Is an underlying contract to buy or sell a bond or a currency or commodity? We need to know the option cost, also known as the premium or price. We didn't know if it's a call or a put. We didn't know the exercise type. There are two major exercise types. Some options might be European style. In that case, it kind of looks like a cancelable forward contract. It might be a one-year option to buy IBM at $200. That means on the maturity date, say 2 years from today, you have the option to exercise and buy IBM for say $200 for a call, or if it's a put, an option to sell IBM for $200 in 1 year. On the other hand, American style options give the holder the right but not obligation to exercise the option and for a call buy or for a put sell any day between now and maturity. Maturity will be the last day the owner of the option has to exercise. Also with options, we talk about you can have multiple strikes. Unlike forward contracts, there's only one forward price at each maturity date, which is considered a fair price in which buyers and sellers of the asset get together and enter into a forward contract. And since there's no cash changing hands, there's only one forward price at which both parties agree is a fair price. And we've talked about that. That fair price is the no arbitrage price, right? We said that the price reflects the cost of carry. However, with an option, every maturity date can have multiple options. So I say IBM is currently selling for $200 in the market. You can get an option that has, say, a 190 strike or a 200 strike, a 220 strike, a 300 strike, or even a 100 strike. And the reason why you can do this is because options have premiums. So I could negotiate, say, a 200 strike option at IBM, and the current price of IBM is $200. We call that an at-the-money option. In other words, the strike price is the current spot price. And say you negotiate a fee, say $10 to buy that, to have that option. Well, you might talk to the seller and say, you know what, how about I give you a little more money? Why don't you give me a cheaper strike? I want to buy IBM at $190. So you can negotiate a $40 price to buy at $190. And then you can say, well, what would you charge me to have an option to buy IBM for $100? When the current price is $200, so that would be more valuable. They might quote you a price, well, give me $90 or $100 for that option. So once you open yourself up to having premiums associated with these contracts, then you can just negotiate any strike. Any strike that's equal to the current spot price, we'd say is at the money. An in the money option is an option in which you could immediately exercise and make money. So for a call, that would be, say, a strike price less than the spot. So all of these strikes for a call would be in the money. I could exercise and buy at 100 and sell at 200, buy at 90 and sell at 200. There's my at the money, 200. And then for a call, anything above 200 would be out of the money. I wouldn't exercise those. And for a put, it's the other way around. For a put, from the perspective of the owner of a put, I'd rather have a high strike. I'd rather have an option to sell IBM at, say, 300 when the current price is 200. So that would be in the money for a put. And these would be out of the money for a put, the low strikes. When we talk about the payoffs of a long forward versus short forward we covered last time. If I'm long the forward, I'm the buyer of the asset. I'm going to pay the forward price and take delivery of the asset, and then I can immediately sell it into the spot market and get it the spot price at maturity. So we say our profit is ST minus F. For a option contracts, it looks similar, that I could exercise a call option to buy at the strike price. We usually denote that with an X or a K, usually in finance. So I could exercise, buy at the strike price X, and sell into the spot market. So it kind of looks like the forward payoff. However, with an option, you can always walk away. So we say it's the maximum of 0 ST minus the strike, meaning if ST minus the strike is a negative number, do not exercise, and your payoff is 0. So once you've paid for the option and had that sunk cost of the premium, you can't lose money after that, because you can always just walk away and get ST minus the strike. Now the short forward. A short forward is a contract in which you are going to deliver the asset. You're going to receive the forward price. So deliver that to the long party. You're going to buy it in the spot market and deliver it, and that's your profit. Now for a put, we say the payoff is the maximum of X minus ST, not F minus ST, because you can always walk away again. Now for profit. Now for forward contracts, this is the profit. This is also equal to the payoff. For an option contract, this is my payoff, but my profit, I need to subtract off the cost, right? Because there's no cost of the payoff for forward. So if I take my payoffs and I subtract off the cost of the option, say the call premium times the Q, or the put premium P times the Q, that would be my profit. To value option, you need to know a lot of information. You know, is it a call or a put? Is the American or European style exercise? What's the maturity? What's the strike? What's the spot price of the underlying asset? Say, what's the price of IBM? We're talking about a call in IBM. And then lastly, what is the annualized volatility of the underlying asset? So the insight here is the option price will increase in value as the volatility increases. Because remember, as long as you have if you buy an option on a volatile asset, as long as there's potential for big stock price changes, that's a more valuable option, because I can always walk away if the price change goes against me, but I'll cash in if the price change goes with me. We also need to know the dividend yield. Think about as a stock pays a dividend, its price will fall. So when we're thinking about whether I need to should buy the stock, I should know when the dividend's paid and what it is. And I also know the interest. I need to know the interest rates. So we're going to value an option on Google. So on February 28th of 2012, I looked into buying a call or put on Google that matures in March of the same year, March 17th, 2012. So it's about a 1-month option. The spot price of Google stock was $6.14. I was looking at both calls. So this is why I went to Bloomberg, Google, Equity, OMON for Options Monitor, and hit Go in Reuters or in Bloomberg. And I got calls on this side of the screen and puts on this side of the screen. And the way you read this, you have, again, calls, puts. These are all maturity dates, March, April, June, September, January, the following January, and the same for puts. And then for each maturity date, you have different strikes. So here you see the 610 strike, 615 strike, and 620 strike. And notice that for a call, the price gets cheaper if you would negotiate, say, a higher strike. It would be cheaper for me to buy Google at a higher price than a lower price. So we see the 615 strike March 17th call on Google, trading for about $10, 9 bid, 10 ask. And then the 615 strike March 17th Goog put is selling for about $10 and about 50 cents if I look at the hour between the bid and ask. So I'm going to price this option again. So what I learned here, I have a maturity date, March 17th. Today's date, March 28th. Spot price 614. I now need to know the volatility of Google. So I'm just going to take the 40-day trailing moving average volatility. So over the last 40 days, again, go into Bloomberg Goog Equity HVG for historical volatility graph. And I ask for the 40-day trailing volatility. It's running about 30%. So I'll use that for now. I look on the details of the stock. So I hit Goog Equity Description, DES, and see that it pays no dividend. And I need to know the risk-free rate, the treasury rate for about a 1-month maturity, and that's about 10 basis points. So now I'm ready to value the option. So what I'm going to do is take this, I'm going to grab the data, copy it, and I'm going to go to Excel. I'm going to click out of there. And I want to go to Excel. Let me just resize that. And I want to paste. All right. So I have today's data, February 28, 2012. Option matures 3/17/2012. Strike of 615. Underlying stock price is 614. No dividend. 10 basis points is the interest rate. 30% is the volatility. And it matures in 18 days. If I just take the difference between the current date, 3/17, and the current date, 2/28, and the maturity date, it's 18 days. And if I take 18 days divided by 365, you make sure you use calendar days. It matures in 0.049 years. What I want to do is I'm going to value this option using Monte Carlo. Now, Monte Carlo model is a model in which you create a stochastic variable, say the stock returns, simulate many possible outcomes, and evaluate the output. So what I'm going to do is I'm going to simulate stock prices using my random walk model. So I'm going to use a slightly different random walk model. I'm going to use a continuously compounded random walk model. So normally, when we did a random walk model, we used a model that the spot price, say next period, we'll say ST plus H, where T is today, is today's spot price times, say, 1 plus R plus a random number times sigma. And if we're doing it for more than one period, you have sigma times the square root of time and R times the square root of time. So that is my stochastic model. But if we assume that interest rates are continuously compounded, we use this model here. The spot price next period equals the spot price today. Now H is the increment of time between now and my stock price change, is equal to that spot price times e to the r minus the dividend yield. Remember, we said stock prices fall by dividends, minus 1/2 the variance times H, plus sigma times square root of H times Z. So I'm going to take that formula. I'm going to generate 10,000 possible stock prices for Google. Once I have 10,000 stock prices, I am going to get 10,000 payoffs of the option, take the present value, and a fair price for an option could be the average of the present value of the payoffs. So let's go ahead and build that model. So I'm going to go back to Excel, and let me calculate a few things. Let's first of all say that N is the number of stock price changes. All right, now this is not going to be relevant for this particular example, but it's going to make a difference when we do some other things. So let's just allow stock prices to change one time between now and the maturity of the option. That's going to be our increment of time. So my H is going to be the time between stock price changes. I'll just take my maturity option of T and divide by N. So in other words, the stock price change is just going to happen in 0.049 years. Next, I'm going to calculate a random variable, Z, and I'm going to use at risk. So I've already launched at risk, so I can see there's the functionality up here. So I'm going to type in a standard normal distribution variable here, risk normal 0, 1. So that's my random Z. And then I'm going to go and grab a function that I wrote that has the continuously compounded stock returns. So I'll grab that function, copy, go back to Excel, Visual Basic. I'm going to insert a module and paste that function called StockSim. Needs the spot price, the interest rate, dividend yields, volatility, time between stock prices, H, and Z. And I'm going to insert that function here. So I'll call that my simulated ST. Simulated stock price. So I'll insert that function. User defined. StockSim. And let me put in my variables. Stock price 614, interest rate, dividend yield, volatility, time between stock price changes, that's my H, and the last thing I need is my random Z. So this is my simulated, this will be my simulated stock price. Let me just change format a little bit. Now if I were to run an at risk now, let me just make this say an output, at risk, add output, OK. And if I were to run, say, 10,000 iterations, it's going to generate 10,000 stock prices by generating 10,000 random variables. So you can see here my 10,000 stock prices. The mean is about 615. And you can see the 5% lowest is about 549, 5% highest is about 683. So these are my 10,000 possible stock prices. Now I can calculate 10,000 option payoffs, but specifically I want to take the present value of a call payoff and the present value of a put payoff. Alright, so I'm going to take, and the reason I'm going to do that is I want to generate 10,000 possible call payoffs. Take the present value of all those, and the average of that is what I would pay for this call. So let's say equals for a call max 0, comma, simulated stock price minus the strike, 615, And I'm going to take a present value factor. E to the minus RT is a present value factor, discounting at 10 basis points for 0.049 years. So now that would be the present value of the payoff if the price turns out to be $6.12. And I'll do the same thing for the put. Equals max 0, comma, strike minus simulated stock price times exp to the minus RT, my present value factor. So these are my two payoffs from options if the stock price turns out to be $6.12. Now if I were to run a simulation on, say, the call payoff, let's make both of these outputs, highlight both these cells, at risk, add output, and I'll click on, say, this one right here, call payoff, and run 10,000 iterations. It's generating 10,000 call payoffs. These represent all the situations where the price drops and the payoff, the option winds up out of the money and the payoff is 0. And these are all the other positive payoffs. And what we see is the mean of this distribution is $15.99. So that would be a fair price to pay for this option. So I'm going to actually get that statistic in at risk. It just equals risk mean, and click on an output. That tells me the mean of that distribution and the mean of the put distribution. And this is the Monte Carlo valuation of the call and put. All right, so let's step back and see what we did here. We gathered information on Google. Maturity, volatility, interest rates, dividend yield, current stock price, and strike price of an option. We then used a random walk model and generated 10,000 different stock prices. We then generate 10,000 different option payoffs. And a fair price to pay for this call would be the average payoff in a month. That would be a fair price to pay in a month. But I take a present value of that to be the fair price I would pay today. So fair price is $15.99 for a call and $16.69 for the put. Now we could have done this a little bit different. We could have written a macro to do this problem. Right? And it'll give us very close to the same value. So I could have a macro Monte Carlo solution. So what I would do is, again, I would need a random Z, but without at risk, I would use my norm S inverse ran. Now every time I hit F9, I'll get a new random number. And then I'd put in my stock sim. Putting in again the current stock price, interest rates, dividend yield, volatility, H, time between stock price changes. I'll just put that in for now. And then Z, which is my random number. I'll move that over here. So this is my simulated ST. Now, every time it gets recalculated, I get a new random Z, and I get a new random stock price. I can then write a macro to record 10,000 STs. So if I can write a macro, I can say copy this value here and paste it. Recalc, say grab this value here and paste it, and keep going. So I just need to create a macro that copies whatever's in this cell to here, here, and here. And here's what that macro would probably look like. I called it sub sim now, open close paren, for I equal 1 to 10,000, next I, and sub. This is my cell that has that price, so 15.2 must be this cell right here, 15, so B15. And then 13.4 must be this cell here, because it puts it here, and then here, and then here. So I then just need to run a macro that gives me 10,000 possible stock prices. And again, here are the inputs for my stock sim: current stock price, interest rates, dividend yields, volatility, H, and my Z. I can then calculate the present value of call payoff, just like I did with at risk. And I can do present value of put payoff. Now the present value of call payoff equals max 0, comma, simulated stock price minus strike. I'll anchor that strike. And I could copy that down, say 10,000 times, and do the same with the put. Max 0 strike 615 minus simulated stock price, and copy that 10,000 times. And then if I were to done that, I'd take the average of these 10,000 numbers. That would give me numbers comparable to the Monte Carlo valuation. So you can see I did here. I took a macro, generated 10,000 possible stock prices. That gave me 10,000 calculations of present value call payoff, 10,000 put payoff, again using the present value factor, e to the minus RT. Took the average of this column was 1584, took the average of this column was 1695, which is really close to my Monte Carlo valuation. Now let's talk about Black-Scholes. Black-Scholes is a model that uses the same assumptions as the Monte Carlo valuation, namely that returns are normally distributed and stock prices follow a random walk model. If you do use those assumptions, Black-Scholes and Merton, sometimes called the Black-Scholes-Merton model, came up with formulas. So instead of actually generating, say, 100,000 or 10,000 iterations for a Monte Carlo, Black and Scholes developed a formula. And that formula will give you a similar value. So I'll take those formulas. I'll go to my Visual Basic screen. I'll paste BS call and BS put in. And I can calculate the BS call price and put price. BS call, stock, strike, vol, risk-free rate, maturity, come down and grab the dividend yield. And what you see is your Black-Scholes price is nearly identical, I'll call this Black-Scholes-Merton, to the Monte Carlo valuation. Now if I copy this formula down, before I do that, let me take this formula and let me anchor all the cells. I'll highlight that whole thing, function or F4 to anchor it. I'm going to copy it down because I know that a function called BS put has the same parameters in the same order. So there's my BS put value. So Black-Scholes model is a formula solution to this problem So you can see that Black-Scholes and the Monte Carlo provide similar values. One thing I want to do before we do a little exercise is to value an option on a currency. You do a little trick. So say you're trying to value a 10-month call on $1 Australian dollar. Say the current spot price of an Australian dollar is 89 cents, and you're looking to value a 90-cent strike call or put. Just type in the spot price of the currency, 89, put in the strike price of the option. Under interest rate, put the U.S. interest rate, annualized for 10-month maturity. Volatility, put the expected volatility of the exchange rate returns. Put in the maturity. And the only trick is, if valuing a currency under the dividend yield, put in the foreign interest rate. So in this case, the Australian dollar. This is the interest rate, the annualized interest rate on 10-month Australian sovereign bonds, which is about 2.5% at this time. And that tells me the call price for $1 Australian dollar is about 2 cents, and the put price of this option is about 5 cents. So it'll allow us to do this next exercise. Say that Apple plans to earn 800 million euros exactly 1 year from now from the launch of a new iPhone in Europe. And Apple's considering hedging the position with an option or a short forward to sell the euros to guarantee the US dollar proceeds. They're also considering maybe hedging with less than 100% of the 800 million. So what we're going to do is we're going to calculate the expected US dollar revenue, unhedged, and then hedge using at-the-money puts and then forward contracts. So I'm going to grab the spreadsheet. And this spreadsheet is already completed, but I'm going to go in there and grab it, copy. I'm going to get out of PowerPoint, go back to my Excel, grab another worksheet, and let me paste it in there. So here's the model. So let's look at the assumptions up here. Apple's going to receive 800 million euros. Current spot price is 125. They're going to receive them in 1 year. And let's go ahead and make this the 1-year interest rates. In the US is 1%, and the 1-year interest rate in Europe is 2%. So this would be the interest rate on the closest thing to risk-free sovereign bonds in Europe would probably be the 1-year German Bund rate. So based on this and based on our model that we learned last time of forward prices, my forward price should be the spot price times 1 plus the US interest rate divided by 1 plus the German interest rate. So my forward price should be 123. Now for a currency, the forward price is often considered an unbiased estimate of future spots, which is not true for stocks. So I'm also going to consider this my expected spot price next year. One way of thinking about that is if the markets do not allow arbitrage, if German risk-free interest rates are 2% and US interest rates are 1%, there would be a lot of incentive for Americans to buy German bonds to get 2%. The only way for this to exist in equilibrium is for the euro to devalue by about 1% from 125 to 124. If that were the case, both the Americans would get 1% on US, but they'd get 1% on German bonds because they'd earn a 2% interest rate in Germany, but they'd lose 1% on the currency conversion a year later. So that's one way of thinking about why the euro has to devalue, because they have higher interest rates. And let's assume that the expected standard deviation of the exchange rate changes are 11% based on historical values. And I can value a put. Now I'm looking at a put to hedge this because I need a contract to sell 800 million euros at a fixed price. So I'm going to value an at-the-money put on the euro. So I put in BS put, or I put in my spot price. I put in my strike. I put 125 in because, again, I said it's an at-the-money strike. And then I put in all the other information, including the dividend yield, which is the German interest rate. And it says that the price of 1 year call on the euro for 125 strike would be 6 cents. Or if I need to buy a put on 800 million euros, that'll cost me about $48 million. That would be the total cost if I did 800 million. All right, coming down a little bit. Now the expected appreciation of the euros, about negative 1%. That's just the percent 123.7 minus 125 over 125. So I expect the euro to devalue about 1%. And then we calculate the expected unhedged revenues. So let me change that to expected. Now the expected 1 year revenues is simply the expected spot price, 123 times 800 million. So I expect to get $990 million next year. However, the exchange rate is not deterministic. It's stochastic. We don't know what it's going to be. We think it has a standard deviation of 11%. So let's assume that the returns on the euro, the percent changes in the euro, are normally distributed. If I do that, I can do a random walk model of returns on the euro. So I'll take the spot price of the euro times 1 plus the expected appreciation, negative 98 basis points, plus risk normal 0.1 times the standard deviation 11%. So all I'm going to do is type this formula into Excel. Spot price times 1 plus the expected appreciation plus risk normal 0.1 times sigma. And then I'm going to click on go to my at risk and click on add output. And if I do that, and again, I already had done that, that's why that formula is in there. Now, if I were to run 10,000 iterations, now I can get a picture of what the 10,000 possible exchange rates could be. So you can see, based on this model, it looks like the exchange rates could be between, say, $1 and $1.50. That's my 90% confidence interval. So that gives me an idea of the variability of the euro. So now I'm going to do one more thing. I'm going to estimate, well, what's the 90% confidence interval of my revenue? All right. So I'm going to change a little formula here. I'm going to say that my expected or my simulated revenue is my 800 million, that's B2 euros, times the dollar price of the euro, simulated $1.37, that has the risk normal 0.1 in it. Now when I run that one and run a simulation and then browse the results, what I see is the exchange rate, 90% confidence interval, goes from about $1 to $1.50, and my revenues go from about 800 million to 1.17 billion. So that would be my 90% confidence interval revenues, assuming exchange rates follow a random walk process. Now, that one way of getting those values out of a PowerPoint or out of at risk without typing the numbers in, you can use the function equal, and this is an at risk function, equals risk percentile. And then I'll put in the output cell. This is an output, comma 5%, and then risk percentile, comma 0.9 for 5%. That'll give me the 5% lowest and highest. So again, my 90% confidence interval from that graph was 800 million to 1.7 billion. Now say you want to simulate the effects of adding an option on, say, 100% of your expected euros. So say I buy an option on 100% of my euros, so 800 million euros. What would the payoff of that option be? Well, I'll just input my formula for the payoff or the profit of an option. All right. So that formula is going to be, again, ignore this part because this is when I hit add output, that's what gets added. So what I really input is 100% of 800 million euro, so 800 million euro, that's my quantity, times max, since this is a put, 0, strike minus the spot price, simulate spot price, minus the cost of the option per euro, which is my BS put price. So this is the profit on 800 million euros based on the simulated stock price. Again, this X, the strike, minus the simulated stock price. So if I run 10,000 iterations, these are the payoffs of the option. Now if I come down here, this is the net effect of Apple having an expected unhedged simulated revenue of 990. So this formula here just adds this number, 990, plus the simulated profit of the put, 38,508. But now when I run a simulation, this shows me the payoff of having both an 800 million receivable in euros and having it all hedged with a put. So it's a combined payout or profit. If you look at this graph, what you see is the worst case, the minimum is actually $951 million. What that worst case actually represents is this is a put option to sell 800 million euros at $1.25. So the worst case is I sell 800 million euros at $1.25 and I lose my $48 million, or I've already spent my $48 million premium. That's what the 951 million represents. However, there is a fair amount of upside because if the exchange rate were to appreciate past 125, I would not exercise the option and I would receive a lot more for my euros, so I retain much of the upside. So you can compare, say, this unhedged payoff with this payoff plus the option profit. What you see is the worst case is a lot better by using an option. The best case is a little bit lower. If you notice these numbers, it's a little bit lower by about $50 million, which is the price of the premium. And the last thing I can do is I can set up a formula here for the payoff of a short forward on 800 million euros. So I have 100% of 800 million euros. I'm hedging 800 million euros with a short forward, which is the forward price minus the simulated spot. And if I then add my unhedged position right here, if I put in a formula here, which is the unhedged simulated US dollar cash flow, plus my simulated forward, and I run at risk, I get a graph that looks like this. Actually, a distribution. Notice what this distribution is. The min is 990, the max is 990, the mean is 990, the mode is 990. Every single value is 990 because in effect your exposure to the euro is completely offset by your position in the forward contract. And that makes sense because you are definitely going to sell 800 million of euro next year, and you have a contract to sell 800 million euro at a price of 123, which is 123.7, which is the forward price. So you are perfectly hedged. You will always get 990. So now you have a choice. Do I hedge none and get this exposure? Do I hedge all of it with options and get this exposure? Do I hedge all of it with forwards and get this exposure? Now I could change the hedge ratio to 50%. Now effectively what it does is it then treats this as an option on half our quantity, or 400 million euros, and a forward contract on half the euros. Or I could even do, say, a mixed strategy. Maybe I could have a situation where I add the unhedged position plus maybe half of my risk is hedged with a forward and half of my risk is hedged with an option. I can have a mixed strategy of combining all three of these. So then it becomes a choice for the firm. Do they want to accept the risk as it is, enter into forward contracts that take no risk, or enter into option contracts to reduce their downside but give up a little bit of their upside? And then what percentage should I hedge? Maybe it depends on how certain that 800 million is going to be. If I'm only, say, 90% certain that that's the quantity, maybe I'll only hedge 90% of my exposure. And it also could be the fact that you may not have a budget for, say, $48 million of option premium. And some firms are just also known to be more risk or less risk averse than others. A firm like Apple, which has so much cash, might decide just not to hedge. Right? They're not going to go bankrupt. They're flush in cash. So why have the expenses of options or worrying about forward contracts? Right, so that's a simulation of a receivable in euros hedged with forwards options. Last thing I want to do is talk about exotic options. Exotic options are options whose payoff are not just a simple formula of, say, max ST minus the strike price for a call. So let's look at something called an arithmetic Asian option. An arithmetic Asian option's payoff depends not just on the last price you may see, say the last price of a stock at the maturity of the option, but it depends on, say, the average of stock prices over the life of the option. So let's look at a particular option. Say you have a 3-month arithmetic Asian whose payoff is the max of 0 or the average of the next 3-month end prices minus the strike. All right, so it depends on what prices are in month 1, 2, and 3, not just at the end. So we're going to value this arithmetic Asian by doing a simulation of stock prices at the end of the first month, end of the second month, end of the third month using our stock sim continuous function, where I'm going to plug in an H of 1/12, 1 month, and I'm going to simulate the prices. So let's see what that model would look like. So I'm going to grab this data, and again, this is another at-risk model. Make sure you close out of PowerPoint before we go to Excel. I'll add another sheet here. So here's my model. What if a current stock price is 407? You have a strike of 400, matures in 3 months. Interest rates are 5.5% annualized. Volatility is 45%. Stock pays no dividend. And I'm going to value a stock which depends on the month-end prices for the next 3 months. So when I enter in my stock sim formula, I'm going to simulate stock prices for the next 3 months. I'm going to assume stock prices change 3 times. Or the time between stock price changes is 1 month or 1/12. So that's going to be my H for stock sim. So we'll go ahead and put in stock sim. Current price is 407. And again, I'm simulating my price in 1 month. Interest rate, 5.5. No dividends. Volatility of 45%. H is 1/12. And my random Z is right here. Is my risk normal 0.1. And then I'll put it in end of month 2. Now notice what I need to do here. My beginning stock price is not 407. It's whatever it wound up in month 1. And my random shock is not the shock in month 1, but it's the shock in month 2. So we have 2 independent shocks. And then I'll put it in for month 3. Again, my stock price, the beginning stock price is the price at the end of month 2. And my Z is the shock in month 3, which is independent from month 2 and 1. So when I run at risk, I'm going to generate 10,000 sets of 3 randoms, which give me 10,000 sets of stock prices. If I then have a formula here that takes the max of 0, average of these street prices minus the strike, times the present value factor, e to the minus r times the final maturity, since this is the payoff at the maturity of the option. So I want to make sure I discount it back for the full 3 months and not 1 month. And if I run that simulation, again making this an output, the average present value of payoff is going to be about $30-some, and that's going to be my Monte Carlo valuation of this arithmetic Asian. So $31. I'll do a risk mean. That'll give me the mean of the distributions. And for the put, it's $20. So this is how you can use Monte Carlo estimation to value an Asian option. And it also shows you the versatility of Monte Carlo. You know, a lot of times you might ask, well, why do we need Monte Carlo if we have the formulas for Black-Scholes? Well, Monte Carlo will allow us to value all types of options, any option you can think of, as long as you can figure out a way to model the stock price. So in this topic, we've talked about computing the payoffs and profits of plain vanilla options. Plain vanilla meaning just standard terms, European calls and puts with a standard payoff. We valued options using Monte Carlo simulation and Black-Scholes, computed hedged and unhedged cash flows using options and forwards. We valued arithmetic Asian options and used at-risk to value options to compute position risk like we did with Apple.